Gold didn't just rise in 2024. It broke through psychological barriers that held for decades, then kept climbing into 2025 as if gravity had been repealed. We saw the metal surge past $3,000 an ounce, a number that analysts once dismissed as fantasy. And here's the contradiction that should stop you cold. There was no world war, no pandemic, no bank collapse on the front pages. The usual catalysts that send gold screaming higher were nowhere to be found, and yet the price moved like something was on fire. So the question isn't whether gold moved. The question is why. Why did central banks accelerate purchases at the fastest pace in modern history? Why did institutional investors quietly reposition billions while retail traders were distracted by meme stocks and cryptocurrency volatility? Why did physical premiums in certain markets diverge so sharply from paper prices that it felt like two different assets were trading under the same name? By the end of this video, you'll understand who benefited, how the mechanism works, and why this pattern has played out before. More importantly, you'll understand what it might mean for your portfolio in 2025 and 2026. Welcome to the Jack Goldsman. If you're new here, this is where we investigate the mechanics behind market moves that mainstream media either ignores or misunderstands. Subscribe now, because the information in this video will not be repeated by your financial advisor. Hit the notification bell if you want to know when the next investigation drops. And let me be clear from the start, this is not financial advice. I'm showing you data, I'm explaining mechanisms, and I'm asking questions that deserve answers. What you do with your portfolio is your decision and your responsibility. Let me walk you through what happened in the span of roughly 18 months, because the speed matters. In late 2023, gold was trading around $2,000 an ounce, a level it had flirted with several times since 2020, but never sustained. Most analysts expected consolidation. The Federal Reserve was still hawkish on rates, the dollar was strong, and conventional wisdom said gold should struggle in a high-yield environment. Then, something shifted. By early 2024, central bank buying data started coming in, and the numbers were staggering. China, Poland, Turkey, India, and a dozen other nations were adding gold to their reserves at a pace not seen since the Bretton Woods era collapsed in the 1970s. This wasn't marginal accumulation. This was strategic repositioning. By spring of 2024, gold had broken through $2,200. By summer, it touched $2,400. Each time it pulled back, buyers emerged so quickly that the dips lasted hours, not days. Something had changed in the underlying demand structure, and most retail investors had no idea. Then came the fall of 2024, and gold didn't just hold its gains, it accelerated. We crossed 2,500, then 2,700, and by early 2025, we were looking at prices north of $3,000 per ounce. The timeline is critical because it tells you this wasn't a spike. This was a trend. Spikes reverse. Trends reveal structural shifts. And when you compress what happened into a mental timeline, you realize this move occurred while most people were focused on elections, artificial intelligence stocks, and inflation debates. The gold market was sending a signal, and most people weren't listening. Now let's talk about how this actually works, because the mechanism is the part they don't want you to understand. The first thing you need to grasp is the difference between paper gold and physical gold. When you buy a gold ETF, when you trade gold futures, when you hold gold in a brokerage account, you are holding paper claims. You own a contract, a share, a digital entry that says you have exposure to gold. But you don't own metal, you own a promise. And promises are only as good as the system that backs them. Physical gold is different. When you hold a coin, a bar, or you have allocated metal sitting in a vault with your name on it, you have the actual asset. No counterparty risk, no custodian between you and your wealth. This distinction matters because the price you see on your screen, the spot price, is determined primarily by paper markets. Futures contracts on exchanges like COMEX, ETF flows, and institutional derivatives activity drive the number you see quoted. But here's what happens when demand shifts. Imagine you live in an apartment building, and suddenly the landlord announces that rent is doubling next month. Everyone scrambles to either pay up or move out. Some people have cash reserves. They pay. Others don't. They get evicted. In the gold market, the equivalent of rent is margin requirements. When exchanges raise margin requirements on gold futures, traders who are leveraged long must either deposit more cash or close their positions. If they can't come up with the money, they're forced to sell, even if they believe the price is going higher. This creates artificial selling pressure that has nothing to do with the actual supply and demand for physical metal. The price drops on screens, while physical demand remains unchanged or even increases. This is why you sometimes see gold plunge 5 or 6% in a single session, only to recover within days or weeks. The paper market was forced to liquidate, but the physical market never agreed with the move. The supporting mechanism here is ETF flows versus physical premiums. In 2024 and early 2025, we saw periods where ETF outflows coincided with record physical buying in Asia and the Middle East. Western institutions were selling paper claims, while Eastern central banks and high-net-worth individuals were acquiring actual metal. The result was a divergence. Paper prices would dip, but physical premiums, the extra amount you pay to actually get the metal, stayed elevated or even increased. This tells you that the screen price and the real-world price are not always the same thing. When you understand this mechanism, you stop panicking during pullbacks. You start asking the right question. Is this real selling of physical metal, or is this paper market manipulation and forced liquidation? Here's where history becomes your greatest teacher. What we're seeing now has happened before, and each time the pattern rhymed. Let's go back to 2008. During the financial crisis, gold initially sold off alongside everything else. In the liquidity panic of late 2008, even gold dropped as institutions sold anything they could to raise cash. But watch what happened next. Gold recovered faster than stocks, faster than real estate, faster than most other assets. By 2011, gold had nearly tripled from its 2008 lows, reaching over $1,900 an ounce. The pattern: initial panic selling, then recognition that the system had fundamental problems, then a sustained move higher as investors sought safety. Now look at 2020. When COVID hit and markets collapsed in March of that year, gold sold off briefly. Again, liquidity panic. Again, forced liquidation of paper positions. But within months, gold surged to new all-time highs above $2,000. The pattern repeated: shock, forced selling, then recognition, then accumulation. And here's 2022 and 2023. Inflation surged to 40-year highs. The Federal Reserve raised rates at the fastest pace in modern history. Conventional analysis said gold should collapse because higher rates increased the opportunity cost of holding a non-yielding asset. Gold declined from its 2022 highs, yes, but it never collapsed. It held support around $1,800 while central banks quietly accumulated at the fastest pace on record. Once is an accident, twice is a coincidence, 3 times is a pattern. And we're now seeing what looks like a 4th iteration. The setup is different each time: pandemic, financial crisis, inflation shock, geopolitical uncertainty. But the outcome rhymes. Paper markets experience volatility. Physical demand remains strong or accelerates. And those who understand the difference between screen price and real-world value position themselves accordingly. I'm not telling you this to predict the future. I'm showing you that the current environment has historical precedents, and those precedents suggest that the move we've seen in gold may not be an anomaly. It may be the system telling you something important. So what does this mean for portfolios in 2025 and 2026? Let's be honest about what we know and what we don't know. We know that central bank gold buying has been unprecedented. According to World Gold Council data, central banks added over 1,000 tons to reserves in both 2022 and 2023, and 2024 data suggests the trend continued. We know that investment demand, meaning ETF holdings plus bar and coin purchases, reached record levels in certain quarters. We know that global debt levels are at all-time highs, that geopolitical tensions remain elevated, and that trust in fiat currencies is being questioned in ways we haven't seen since the 1970s. What we don't know is timing. We don't know if gold will consolidate here, pull back significantly, or continue higher. We don't know what central banks will do next, what the Federal Reserve's policy path will look like, or what black swan events might emerge. Anyone who tells you they know exactly what gold will do in the next 12 months is either lying or delusional. But here's what the data suggests. When institutions with the longest time horizons on the planet, central banks, are buying an asset at historic rates, they are telling you something about their view of the future. Central banks don't trade for short-term gains, they position for decades. And right now, they are positioning into gold. The implication for individual portfolios is not that everyone should go all in on gold. That would be reckless. The implication is that the traditional portfolio allocation models, 60% stocks, 40% bonds, might be worth revisiting. If central banks are diversifying away from dollar reserves, if physical demand is outpacing paper market activity, if historical patterns suggest gold performs well during periods of systemic stress, then perhaps a portfolio without any meaningful gold allocation is taking a risk that its owner doesn't fully understand. This is Jack Goldsman, and the question I want you to sit with is not whether gold will go to $4,000 or $5,000. The question is whether your portfolio is structured to handle a world where the assumptions of the last 40 years no longer hold. Now let me speak directly to you. I know some of you watching this are scared. You bought gold at a higher price, maybe near a recent peak, and you've watched it pull back. You're wondering if you made a mistake. You're wondering if you should sell and cut your losses. I understand that fear. It's human. But let me ask you this. Did the reason you bought gold change? If you bought gold because you were concerned about currency debasement, has that concern disappeared? If you bought because you wanted insurance against systemic risk, has that risk evaporated? If the thesis is still intact, then a price pullback isn't a reason to sell. It's a test of your conviction. I know some of you are confused. You hear conflicting information. One analyst says gold is going to 5,000. Another says it's a bubble ready to pop. You don't know who to trust. Here's my honest answer. Trust the mechanisms, not the predictions. Understand how paper markets work. Understand the difference between owning a claim and owning the asset. Understand that volatility is a feature of markets, not a bug. When you understand the mechanism, you can interpret the noise for yourself. And I know some of you already understand. You've done the research. You've positioned appropriately. You're not looking for reassurance. You're looking for confirmation that what you're seeing is real. To you, I say, the data supports your thesis, but stay humble. Markets can remain irrational longer than any of us can remain solvent. Risk management matters more than being right. Size your positions so that you can survive being wrong and still benefit if you're right. Let me be clear one more time. This is not financial advice. I don't know your financial situation, your risk tolerance, your time horizon, or your goals. I'm presenting information and analysis. The decisions are yours. The responsibility is yours. If you're uncertain, consult a qualified financial advisor who understands your specific circumstances. There's one more element to this story that deserves attention. Notice how little coverage the gold rally has received in mainstream financial media compared to other asset moves. When technology stocks rally, it's front-page news. When cryptocurrency moves, every outlet covers it breathlessly. But gold hits all-time highs, central banks buy at record pace, and the coverage is muted. Why? One plausible explanation is that gold's rise is an implicit critique of the monetary system itself. Gold performs well when faith in currencies weakens. It performs well when debt levels become unsustainable. It performs well when governments print money to solve problems. The institutions that benefit from the current system have little incentive to draw attention to an asset that thrives when their system falters. I'm not claiming conspiracy, I'm observing incentives. Media companies depend on advertising from financial institutions. Financial institutions profit from complex products, not from people buying and holding simple assets like gold. The incentives don't align with promoting gold ownership. This doesn't mean gold is always right or always a good investment. It means you need to be aware that the information environment around gold is different from the information environment around other assets. You need to do your own research, question the narratives, and understand who benefits from your beliefs. You don't fight this hard against something that doesn't matter. And the persistent dismissal of gold by certain financial voices tells you more about their interests than it does about gold's value proposition. Let me return to the core mechanism one more time, because this is the key that unlocks everything. Paper gold and physical gold are increasingly behaving as separate markets. In theory, they should track each other closely. In practice, during periods of stress, they diverge. We saw this during COVID in 2020, when paper prices dropped, but physical premiums spiked because actual metal was difficult to obtain. We see echoes of this today. When you buy physical gold, a coin, a bar, you pay spot price plus a premium. That premium reflects manufacturing costs, dealer margins, and supply-demand dynamics for actual metal. In normal times, premiums are modest. In tight markets, premiums expand. In 2024 and 2025, premiums in certain markets remained elevated even when spot prices pulled back. This is the market telling you that demand for real metal exceeds what the paper price suggests. Think of it this way. The paper market is like looking at a house price on Zillow. It tells you an estimated value based on comparable sales and algorithms. The physical market is like actually trying to buy a house in that neighborhood. You discover that every listing gets multiple offers above asking price, that sellers are in no hurry to sell, and that the actual transaction price is higher than the estimate suggested. The screen shows one reality, the market shows another. When you understand this divergence, you understand why smart money focuses on physical ownership or allocated storage rather than purely paper exposure. Paper is convenient. Paper is liquid. But paper carries counterparty risk and can be disconnected from physical reality in ways that matter precisely when you need the insurance most. Zoom out for a moment and consider the bigger picture. We are living through what may be a generational shift in the global monetary order. The dollar-based system that emerged after World War II and solidified after 1971 when gold convertibility ended is facing challenges not seen in decades. China and other nations are explicitly working to reduce dollar dependence. The BRICS nations have discussed alternative payment systems and reserve arrangements. The weaponization of the dollar through sanctions has shown other countries that dollar reserves can become liabilities overnight if geopolitical relationships sour. In this context, gold's role changes. Gold is no one's liability. It cannot be frozen, sanctioned, or debased by a foreign government's policy decisions. For nations seeking to diversify reserves, gold is the only asset with thousands of years of history as a store of value that doesn't depend on any single nation's credit. This doesn't mean the dollar is collapsing tomorrow. It doesn't mean the current system will end this year or next year. These shifts happen over decades, not months. But the direction of movement matters, and the direction, as evidenced by central bank behavior, is toward gold. For individual investors, this suggests that gold's role in portfolios may be larger in the coming decades than it was in the previous decades. Not because of fear, not because of doom, but because the structural incentives of major global actors are shifting in gold's favor. Here's where we land. Investment demand for gold isn't hitting records because of retail speculation or short-term trading. It's hitting records because institutions with multi-decade time horizons are repositioning. Central banks don't panic buy, they strategically accumulate. And they're accumulating gold at rates not seen in modern history. They call it volatility. I call it the system showing you its hand. The paper price will fluctuate. It will scare weak holders. It will test your conviction. That's what markets do. But underneath the volatility, the demand structure has shifted. Physical gold is flowing from west to east. Central bank vaults are filling. And the questions being asked about fiat currencies, about debt sustainability, about the future of the monetary system, those questions aren't going away. I'm not telling you gold will go up. I'm telling you to understand what you own and why you own it. If you hold paper claims, understand the counterparty risk. If you hold physical metal, understand that the screen price and your wealth are not the same thing. If you hold nothing, understand that you're making a choice, whether consciously or not, to bet that the current system continues indefinitely without disruption. After everything you've seen in this video, after understanding the mechanism, the historical patterns, and the current demand structure, I have one question for you. Are you holding? Are you selling? Or are you waiting? Drop your answer in the comments. I read them. I want to know how you're thinking about this. If this video gave you clarity, if it showed you something the mainstream won't, subscribe. Share this with one person you know who panicked during the last pullback. They need to understand what they're looking at. This is Jack Goldsman. We don't chase predictions here, we study mechanisms. Because when you understand the mechanism, the noise becomes signal. I'll see you in the next one.